Okay, I'm not going to go on camera for this.
Is where it's appropriate to do so. Good afternoon, ladies and gentlemen, and welcome to the Tortilla Mexican Grill PLC Annual Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I would like to submit the following poll, and if you give that your kind attention, I'm sure the company will be most grateful. And I'd now like to hand you over to CEO Richard Morris and CFO Andy Naylor. Good afternoon.
Good afternoon.
Good afternoon. Hello, everybody. Thank you for joining us. I'll kick straight off with the presentation. Andy and I'll have a quick couple of minutes to introduce ourselves, who we are. So first of all, my name's Richard Morris. I'm the CEO of Tortilla and have been since 2014. My background has been very much always in hospitality, starting back in the early days as a kid at McDonald's, and then I went to work for Whitbread for 8 years when TGI Fridays landed in the UK, so quite some time ago. I then spent some time in the States with Rainforest Cafe, and then was part of the original management team at Blockfine Restaurants from 1999 to 2010. And then I joined Tortilla in 2014, having spent a couple of years with Dales Organic. I felt that the fast service restaurant, quick service restaurants was definitely on the rise back in those days, and I felt that casual dining was going to become slightly overheated and a bit more challenging. And nothing has happened that has changed my view on that. And I'm very happy to be talking to you today about what's been a very successful 8 years for the business.
Good afternoon, I'm Andy, I'm the CFO at Tortilla. I started my career at Deloitte doing the classic ACA route. I've always been a numbers guy, did a physics degree, so clearly love numbers a lot. I spent a lot of time working really with oil and gas and energy businesses there, AIM and FTSE listed, so I got some good PLC experience. And then decided I wanted to do something a bit more tangible. So I love eating out, so I joined Gaucho and spent about 4 years there. It was a nice break from talking about energy and derivatives and those sorts of things. Sold the business to Ecclestone while I was there, and then I moved on to Tortilla. I've been here for 5 years, and Rich and I have been exploring obviously lots of new opportunities for the group in recent years as well, which we're going to talk a bit about later.
Okay, so introduction and highlights, just to talk you through. I've envisaged this presentation as about half an hour, and then obviously hopefully we'll have some questions from you guys. We would like to believe we'll probably answer, we'd like to think we'll answer a lot of your questions as we go through the presentation, but anyway, by all means, send them through and then we'll look forward to taking them at the end. Andy will do a financial review for you. I'll talk about our strategy and operational review of last year and the first quarter of this year, and then the outlook of how we see the sector and what's been going on in the sector. Clearly an awful lot right now, and we'll hopefully try and allay your concerns about the hospitality sector, which has certainly come under some fire over the last couple of years. So first of all, a bit of background on Tortilla. We're the largest and most successful fast casual Mexican restaurant business in the UK, which is great. We're now up to 68 sites worldwide. And the business was founded in 2007 by a San Francisco guy called Brandon Stevens, who was born and bred on burritos and tacos in the Mission District in San Francisco. Came over to London Business School to do a thesis, realised how dreadful Mexican food was in London back in 2007, and actually did a thesis on Mexican food. And wonderfully, he kind of lived out his dream and opened his first Tortilla in 2007 in Islington, and the rest, as they say, is history. We're now at 68 sites around the world. One of the key pillars you'll hear us talk about a lot in this presentation, and why we've been so successful and are very excited about the future, is around value for money. even more important now as the world enters another difficult phase. People love eating out, but they definitely do start to look at trading down when things are tough. So we think we're well placed to benefit from that. The business has been consistently successful since its inception, and sales have grown year on year since 2007. We have a great central production kitchen, which allows us to grow the business quite quickly now, because that produces 70% of our menu items from a central location. And we also have a head office that's now set for growth. And we'll talk through the future opportunities for us. And one of the key reasons for doing an IPO and becoming a listed business was we wanted to get the access to cash, and we wanted to make the most of the opportunities that COVID has definitely thrown our way. So for the highlights of last year, we were able to add 7 new sites to our estate during this time, and bringing our total number to 64 at the end of last year. We opened 3 new sites in Exeter, Windsor and Edinburgh, and 3 delivery kitchens in Balham, Brent Cross and Manchester. And we also entered a new partnership with Merlin Entertainments, and we opened our first site with them at Chessington World of Adventures in April of last year, and that was very successful. And we just reopened it again for this summer. We also expanded our partnership with SSP by opening one in Gatwick Airport at the back end of last year, and Skelton Lakes, which is a motorway service station. Both testing sites for us in terms of seeing whether we worked in airports, seeing whether we work in service stations, and they've been very successful. Gatwick Airport is now doing £50,000 a week, which is fantastic. As the airlines have opened up and the airports have opened up, we're really pleased with how well that's performing. That follows on from opening, changing one of their original Mexican sites in Euston Station, which was a business called Mi Casa, which frankly wasn't very good, but they were keen to change that brand to Tortilla. And we took that site in Euston Station that was doing £7,000 a week, and we're now doing over £20,000 a week there. So again, relationship with SSP is very good, and we're very excited about the future of them. Our own company sites, where we will open 45 sites over the next 5 years. This year, we are already pretty much locked and loaded for the 9 locations that we've agreed to do. So our pipe for sites for 2022 is looking very strong, and we're already starting to load up for 2023 and beyond. The property market has no doubt been in our favour since COVID, and we'll go into that in a little bit more detail as we go through the presentation. Andy will go into more detail on the financials, but the headline numbers for us last year were transformational for this business. We took our revenues up to 48.1 million, whereas in 20 we were at 26.8, in 2019 35.5. Phenomenal sales line for us, despite all the various COVID-related closures. Our like-for-likes versus 2019 were plus 23.8, and even allowing for the VAT benefit, that's still just under 12% like-for-like for that period. So we definitely benefited from the challenges that COVID presented. Our EBITDA number was 8.7 million against full year 20 of 2.4 and 2.5 in 2019. So a huge change, of which obviously there was some government benefit in there, but even so, a wonderful year for us. And a year that allowed us to introduce our brand to an awful lot of people that probably would not have had the opportunity of eating tortilla or would not have chosen to eat with us. And I think, again, as we go through, you'll see that we're not just a COVID success. There was success pre-COVID, and we've continued to trade very strongly since COVID. We're a very strong balance sheet now, which is great, which means we're able to grow the business out of cash. And whereas a lot of our competitors and other businesses in the sector are licking their wounds and rebuilding their balance sheets, we're putting our foot down and taking full advantage of the market in its current situation.
Okay, so onto some numbers to build on what Richard briefly outlined. We obviously had a fantastic year last year. That sales growth of nearly 80% came from three areas really: new sites that we added during the year, strong underlying like-for-likes in our existing estate, and also just less restrictions on the business in 2021 than 2020. I say only, but we only lost 285 weeks of trade last year, which represented about 11% of the total possible. The year before we lost around 33%. So those three factors combined to a transformational year. The like-for-likes are fantastic. I've got more on those on the next slide, so I won't dwell on that too long here. Gross profit margins were very strong, and that's because some operational efficiencies that we introduced to the business as part of during the pandemic. It's funny, people often say out of a crisis sometimes some positive changes come, and we really refined some of our ordering and cooking procedures during the pandemic to make sure that we were absolutely minimising wastage. Administrative expenses increased during the period significantly, obviously, as we were open for longer, we had more staff employed and incurring delivery commissions. The key metric for us is our adjusted EBITDA as a percentage of sales, which is around 18% for 2021. That's not what the normal run rate will be going forwards. I would estimate once you strip out government support and the world as a normal place, would be around the 12% mark, which is very healthy in our sector. Profit before tax increased to just over 3 million, and obviously we're going to hopefully have many more years of delivering some very strong profits going forwards. Now on to a bit more information around sales, which is a bit more detailed. I'm sure some of you were a part of our presentations previously and will be familiar with this, but the bar chart is a particularly interesting one because what it shows you is the average weekly sales towards here before the pandemic. So you can see in January 20 and Feb 20, we were doing around 750, 800,000 pounds of sales a week. Most of that coming in store, the gold bars delivery, so that was around 16, 17% of sales. We shut our sites in April, or late March in fact, and then we began reopening in May, which was the best decision we ever made. We were very encouraged by how well we traded when we reopened, and so we really accelerated the reopening to get ahead of our competitors. And by doing that, we really introduced our product to a lot of new people. You can see, incredibly, by the time the summer came around, our sales were pretty much back to the level they were pre-COVID, around 800,000 a week. And they stayed at that level pretty much thereafter, with a bit of a dip in January and February, because again, the government introduced restrictions and lockdowns. Things reopened on the 12th of April. That was what the non-essential retail day that reopened. And our numbers went from strength from that. And that just goes to show that those customers that we acquired remained loyal to us. They like our products and they continue to order it, whether that be via delivery or in-store or takeaway. Like-for-likes were fantastic. And in fact, if you back out the period prior to the 12th of April, our like-for-like sales growth increases to over 30%. And that compares to an industry benchmark of just over 1%. So fantastic profits, and also very strong spread of profit across the UK, which is incredibly important in a rollout story like Tortilla across the UK, where you want confidence in your brand to be able to deliver outside of the M25. So that gives us lots of expansion confidence for our plans. We average 350 grand inside the M25 and 300,000 outside the M25. So very strong performance nationwide. And then lastly, there's a little line graph that just shows you in the bottom right corner our like-for-like sales growth compared to our competitors, and you can see that we're always maintaining a very healthy differential. So moving on to the balance sheet, just quickly on this, the only real headline news stories here are obviously the IPO brought in some additional funds. So we brought in 5 million of gross funds, which was more than enough to offset the costs associated with that transaction. And that's given us additional liquidity for us going forwards. We also then did a refinancing of our debt facilities. So we've only got 3 million of drawn debt. We've got a total 10 million facility available, so there's 7 million undrawn, which we can access should we need. And actually, this is a highly generative cycle. We get cash in immediately from customers, pay our suppliers later. So actually, we can self-fund our rollout plans, which I think is incredibly important in a world where we want to keep low leverage levels.
I'm sure these areas are areas that you would have brought up or will bring up as part of the questions. This is all we're seeing in the news right now, following on from all the other challenges, and now with the war in Ukraine, and that's added some other areas which Andy will go into. I'll just talk to you a little bit about the labour market in the UK. Again, you'll have seen and read a lot about the challenges that has presented for the hospitality sector and other sectors. The reality is that, yes, it's true, there's no doubt that this is a business that relied heavily on immigration, and a lot of our employees were non-UK. That's the same for everybody in this sector. So it has been a challenge, but the difference for us is this is a business that's we've spent a lot of time making sure that the businesses are as simple as they possibly can be. I mentioned earlier about the central production kitchen that produces 75% of our food. So when the food arrives in the stores, they're generally just regenerating the products, reheating the marinated meats and the beans, and just producing 3 or 4 of our salsas, which are beautiful, wonderful products. They're very, very simple to produce. So the end result of all of that is we do not need skilled staffing in our businesses. We are able to recruit from the market that now is the 17, 18-year-olds, and that market is fine for us. Yes, there are differing challenges of employing younger people like that. You have to kind of hold their hands a little bit longer and help them, but fundamentally, it's not a difficult business to operate. It's very busy and physically quite tiring, but actually the benefits for young people working for us are, A, that we generally are in city centres, so travel to and from our restaurants is very simple for them. Public transport's generally very good. We don't trade late into the evenings, so there's no fear or concerns of travelling around after the pubs have kicked out and things get a bit messy. So they're able to be gone and probably at home by 10, 10:30 if they're working in the evenings. That's a big plus. They love our product because it's great fun and it's a little bit different and it's very customisable. And the people that work in our restaurants are the same demographic pretty much as the people who eat in our restaurants. Our demographic is around their age group, up to 30, 35-year-olds. So they're serving people who are similar demographic to themselves. We offer various perks to work for us, which we think are really good. They get discounts in local businesses, and they're fun places to work. You know, yes, it's quite tough, and when we're busy, but it's good, and it's a place that they feel comfortable in. We've opened a couple of restaurants last year, one in Windsor specifically. Windsor is a town with no university, and we opened that business with a load of 17, 18-year-olds, and it's been fine. So that's the market that's out there, and for us, it means that we are able to continue to open our sites with those people running them for us.
And in terms of the other two hot topics at the moment, other than labour, utilities is an interesting space. We've so far had a successful strategy. We didn't lock in our supply in November, October last year when things were at all-time high. And that has saved us money so far, although the markets have since gone up again since. So it does remain to be seen where that will land. But it is important to say that we actually have very little utility costs compared to other restaurant businesses. You know, before all these increases, we were around 1.5% of sales on utilities, and we're aware that the common sort of threshold for a lot of other bigger businesses would be to be nearer 3% of sales. So with things doubling, our doubling is less doubling than everyone else's. So we feel pretty well protected on that front. We made lots of allowances for inflation in our numbers when we did our work last year. And the same with our supply contracts as well on food. We've taken some mitigating steps so far this year that has meant that we've not had any price increases. And we're pretty confident that we've been able to mitigate a lot of the increases that might come out of the Ukraine situation by making changes to our supply chain without altering what we do necessarily. So we're pretty bullish on our ability to convert at the profit level as well this year. And then just to touch very quickly on something that we wanted to put into the presentation because we feel it's extremely important with people predicting that inflation may hit 8% in April. We are very well priced. You can see in the graph there, compared to a lot of our competitors, we are very well priced. And we do believe that if there is a downturn in consumer confidence, etc., that people will favour the sort of good value for money businesses more than the more expensive ones that are seen as a bit more of a treat. We know that good value is important for our customers. We surveyed 3,500 of them a little over a year ago, and we know that for them, sort of more than 50% list good value as being a key part of their decision making. So we feel like we're in a bit of a sweet spot price point wise compared to our competitors, and we feel like that will put us in good stead over the course of this year and beyond.
Okay, so current trading first quarter this year, again, pretty encouraging. January was tough, but still the remnants of Omicron around, and January generally is a bit miserable. But actually, it was okay. February and March have been fine, and we have continued to trade in line with our expectations. And more than that was, we wouldn't have expected, especially with all the various challenges that are sitting around us at the moment, even as we move back into a post-COVID world. We anticipated 12 months ago that delivery would fall back down to circa 35-38% once normalised trading occurred and the world was a normal place again. And that's pretty much been proved correct. We are at about 35% of our sales, maybe slightly more than that. Whether they continue to go back up or stay where they are, we don't know. But one thing that's very key with this business, unlike a lot of other restaurants, is that delivery for us contains, and Andy's mentioned this before, but there's profit parity with a delivered product for a tortilla. So we're able to charge more on delivery for our product, which offsets the amount of costs that we have with delivery. I don't know of any other restaurant business that's able to offset those costs as we are. And the reason we are able to do that is, again, because our pricing is so competitive that we're still able to charge £8 on a delivered burrito versus £6.60 in-house for a burrito. So if delivery continues to move forward, it's kind of okay for us. Fundamentally, we're a restaurant, and we would rather people were sat in our restaurants and enjoying our food. But the truth is, if delivery remains, it's okay for us. Challenge for the restaurants is a very different one, and one we're glad we don't have to face. So overall, it's been a very strong start, and with our target of 45 new sites in the next 5 years, and we're very confident that we're going to deliver that. I think we mentioned earlier, we've opened 2 sites already this year, one in Bath, mid-February of this year, and one in Cheshire Oaks, which opened a couple of weeks ago. Both have opened ahead of expectations, which again, considering the world we're in, that's fantastic. Bath's already delivering 20 grand a week, which is great, and Cheshire Oaks has only been a couple of weeks, but very strong start. And we've got signed leases in Bournemouth, Portsmouth, Coventry, and Birmingham is just about signed. So I would envisage by the end of June this year, we'll be up to 6 openings, and with 9 planned for the year, that puts us ahead of schedule, which is very exciting. That alongside with the 3 or 4 cloud kitchens that we'll open, the delivery kitchens, with the franchise opportunities and the licensing opportunities, we should be seeing about 15 or 16 new tortilla venues in 2022. Andy was very much involved in the launch of the Compass Group relationship, which we got involved in them last year. A hugely big opportunity for us with Compass, and one of the big monsters of the sector. We've opened 4 sites in their universities. They're changing all their food layouts in the unis, away from the sort of pick up your tray and wander around scenario to getting brands into their unis. So we've now opened a tortilla in Swansea, Brunel, Middlesex, and Sussex University, and they all look great and they're all performing well. Huge plan for us. They want to do 14 in total, so we'll probably do another 4 or 5 this year. And it's great for us. Students are our staple, the customer. Students love what we do, So we're not only getting them at uni, when they leave uni, they'll be brand ambassadors and loyal supporters of ours as well. So that's a great relationship we've got into, and that'll potentially open doors with other aspects of Compass around sporting venues, Ministry of Defence, hospitals, all of those other areas. So very exciting. We've got to open more delivery kitchens. They've proved to be very successful during COVID. The numbers have come off slightly since the reopening of the world, which is not a surprise, but they're still very good businesses, very little capex involved, so generally profitable. So our platform for continued growth is great with our relationship with Compass, with SSP, with our own company build sites, delivery kitchens, and other licensing opportunities that will undoubtedly present themselves to us as we move forward. The trading environment remains uncertain, of course, and the fairly standard mantra for me on this is, whilst things can be challenging, Tortilla is better placed than most in the sector to deal with all the various headwinds that are coming at us. We have a very favourable property market, and one which we're able to take advantage of, unlike some of our competitors. There will be, potentially, could be shortly, potential acquisition growth opportunities. Who knows? We'll keep our eyes out for those, and should something come up, then we would obviously look at that opportunity. Andy's talked a bit about the cost pressures. Clearly, our operation is much simpler than most other hospitality businesses, so our supply chain disruption has been mitigated to a degree, and we work very closely with our two main suppliers. And so we're all over them in terms of looking at different ways of mitigating all the costs. And again, highlighting the fact that our business is very split from the south to the north. Not many restaurant groups succeed in growing outside of the affluent south, if you like. And we've proved that this business is hugely popular outside of the Watford Gap. And we continue to look for sites up in that part of the world, and we'll continue to grow the business up in the north of England. Finally, I didn't mention the actual graph on the right-hand side. It was really there to highlight to everybody that whilst we talk a lot about COVID and last year, I think it's important to note that this is not just an average business that's suddenly been catapulted into success through COVID. This business was in great shape pre-COVID. Our like-for-like numbers and sales in January, February of 2019 were very strong. We were massively outperforming the Peach Tracker, as we've always done in this sector. So we were moving along very nicely pre-COVID. If COVID has done anything, it has allowed us to accelerate the growth and has taken out some competitors along the way. So it's definitely done us a favour, and we're very keen to make the most of those opportunities. Therefore, our accelerated UK rollout is one of the strategic growth pillars now for the business, to try and open the 15 or 16 differing locations this year. The work with our franchises and partners that we've arranged with through Merlin and SSP and Compass will continue to work on those relationships. Delivery kitchens, will continue to grow those. And obviously the one area we haven't really touched on is something that we will look at probably back end of this year, is international growth. It's fairly clear that the Mexican fast casual sector is very sort of underrepresented in the UK and Europe. And if you look at Chipotle in the US, they have got 2,800 sites, I think, in the US. And we've got 64 or 68. So there's a huge prize out there in Europe, and there's no doubt that it's something that we want to be leading the charge on. It's plenty to keep us busy in the UK, but certainly it would be wrong for us not to look at international opportunities. So again, just highlighting that there is an increase in our acceleration of rollout. 3 sites opened in 21. We're very confident about this year, and we've highlighted that we're pretty much in and locked with the sites that we're going to open this year. A very balanced geographical spread in the UK, which is a big plus, with 5 of our top 10 profitable sites based outside the M25. Our 35% ROCE target is I mean, a bit of a legacy from our private equity days, and there's a possibility that that could come down if we felt we wanted to. But so at the moment, we're more than happy to continue with that plan. We've never closed a site in this estate, which I think is testament to the sort of relentless nature of site finding. We don't take risks. We've got a fantastic property director who's been in the business as long as I have, which is a long time. So he's very well connected and he knows the market incredibly well. So we're very confident that we won't be looking or opening sites that won't work for us. And I think our 45 over the next 5 years is exciting, challenging, but responsible. You know, we're not looking at doing 25 sites a year, but we do think that our growth is exciting, it's good, and it's going to keep us very busy, that's for sure.
We're very busy as well when you consider some of the partnerships and franchising opportunities we've been looking at as well over the last couple of years. I mean, it's I guess the best way of describing the appetite of SSP and Compass to work with us was in a short period of time, Q1 last year, Richard and I sought out some additional revenue streams for the group. We spoke to Merlin and Compass, and we were pushing SSP to roll out more sites in the franchise deal we have with them. And none of them needed a great deal of convincing, if we're honest. They recognised that our food is very much on trend. We saw an opportunity in places like theme parks, zoos, university campuses, hospitals, you know, any canteen arrangement where people want better quality food these days, and they want to have the same brands as they see on the high street. And so we're really excited to get into a relationship with Compass. We know our product works really well with students, and so we want to kind of prove that that works successfully. And it's as much a marketing tool really than a financial one as well, because you know, hopefully we're acquiring future customers, loyal customers. And we do think there's a lot of opportunity to enter into other sectors. Merlin's been a big success for us, so we're very happy with how we've done there at Chessington. And SSP are delighted with how they're trading in Gatwick. They're doing nearly £50,000 a week now, and we're opening up in Bristol Airport in about a week's time. So it's really exciting. And one thing which is very good about our product when it comes to franchising and outsourcing is the fact that we CPU produce a lot of the most tricky items to make, and that really de-risks the food, which is usually one of your largest sort of franchising concerns. So what it means really is, obviously our focus in the UK is very much bricks and mortar, but it does mean that we can supplement that with opening in places that we ordinarily wouldn't be able to get into or wouldn't consider, like contract catering agreements and airports and things. So it's a nice dual attack of white space opportunity in the UK. And then just to move on very quickly to delivery kitchens, I've seen a few questions come in on delivery kitchens on the Q&A, which we'll come to at the end. But it's been a good success for us, delivery kitchens. What we see as the opportunity on that area is to further saturate some of the London zones. So we recently opened up a unit in Balham, and actually that didn't create any new white space for us. But what it did mean is it meant we could take some of the load off our other stores in Wimbledon and Clapham. And actually, as a net, if you look at the group position as a whole, we've generated more profit collectively out of those units now. And so we think there are other parts of London where we could do the same, and it helps us to improve our in-store experiences and sales as well. And the other key area that we see as part of that strategy is to test new markets where we're not quite sure that a market's going to work and we want to open up a bricks and mortar. We could put a delivery kitchen in there, or equally we could open up a delivery kitchen on a short-term contract ahead of opening a bricks and mortar store to seed the market. So there's a couple of areas where we see opportunities there. And actually, delivery kitchens are expanding internationally in Europe now as well, which may play into our successful our plans and strategy.
A quick slide on international, which I've touched on. You know, there is significant international opportunity. We did some white space work a couple of years ago on Europe. There are a couple of countries that came out as kind of red hot potential opportunities for us. We really want to pursue this, but all in good time. We've got a big market in the UK that we're primarily driven to take advantage of. But Europe is something that we are keen to look at. We trade with them in the Middle East with a company called Ethos. They have 9 sites as a franchise over in Dubai, and generally they perform very well. So we've got some success with the franchise partner outside of the UK. And I think because of the gap in the market between Chipotle US and Tortilla UK, there really has to be an opportunity for us to take this forward. It was never a part of our kind of IPO presentation because we are still very excited about the UK, but I think it's important to sort of sow the seed with potential investors that it is something we will be looking at probably by the end of this year. So finally, summary and outlook. Well, despite all the various challenges and headwinds and constant issues that have been thrown at this sector over the last, well, probably since we voted out of Europe in 2016, this business has been able to adapt and pivot and move around and it has come out of everything in very strong shape, and very exciting for Andy and I and the rest of the management team to take advantage of that and to really move this business forward. Last year was definitely transformational for us, record financial results, despite and because of the headwinds really, despite the challenges of sites being closed, but also the fact that a lot of our competitors weren't able to trade, definitely did us a favour. We've got a strong brand. We want to get the name out there a lot more this year. We've got some big plans with our marketing team to do some big promotions for ourselves so that, instead of going for a burrito, you're going for a tortilla, much like going for a Nando's. That's a big plan, to try and get our name out there as much as we can. We are well positioned to navigate the undoubted challenges of the next however long. And we seem to have been dealing with challenges for a long time, so we're quite used to finding a way through them. And certainly with the work that Andy's done in the background with our utility costs and all our supply chain challenges, I'm very confident that we'll ride this storm as well as we have the other ones. We do benefit from being able to trade in many different locations. The fact that we can trade out of 500 square feet or 2,000 square feet, the fact that we don't need extraction, the fact that we don't use fryers, the fact that we have no freezers in our business because we're literally selling fresh product. All of these things give us a really good differentiation against our competitors and allows us to have a relatively competitive capex cost for new sites. By taking extraction out, you're automatically dropping your costs by up to 50 grand. So that's a great way of us to expand the business. Central production kitchen is set, ready to take us to 100 sites. We have recently signed, or we're about to sign, on the space next door to us and in our existing CPU. So we're thinking 2, 3, 5 years ahead to make sure that we can increase the size of our central production kitchen. So that's really good news because finding warehouse facilities at the moment is quite a challenge. So fundamentally, the end result is we are very confident of delivering all of our exciting plans for this business. We do still think that despite everything, we sit in a really good place and we're very excited to take advantage of all of those situations. So thank you very much for your time.
That's great. Richard, Andy, thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just using the Q&A tab that's situated on the right-hand corner of your screen. But just while Richard and Andy take a few moments to review those questions submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Andy, Richard, as you can see, we've received a number of questions throughout today's presentation, and thank you to all investors for submitting their questions. If I could please ask you just to open up that Q&A tab, and where it's appropriate to do so, read out the question and give your response, and then I'll pick up from you at the end. Thank you.
Okay, well, we'll probably just work down the list, actually. So the first one is, as franchising is a high ROCE activity, how can this be leveraged? How many and how fast can franchising grow for the business? I think it's a very interesting question.
There's no doubt that what we've managed to do with our central production kitchen and to mitigate all the issues around franchising, this is now a very attractive franchising opportunity. And there's no doubt that when we talk about Europe, it's almost certainly would be through a franchising opportunity. And I think by streamlining all of our processes and minimising the ability for a franchisor to mess it up, we've done as much as we possibly can on that. So absolutely right. This is a very exciting opportunity for us. Obviously, financially, we're at sort of 20% of a company-owned site, and franchising is maybe 6 or 7. So, really, company-owned sites will always be the preferred route, certainly in the UK. But there's no doubt that for growing the brand and taking us into territories that we don't know, franchising is definitely one of the key drivers for us going forward.
Okay, second one from Jake was around Gatwick. So airports, Gatwick sounds amazing. Revenues 2.5 million versus around 1 million for Euston. How can airports be leveraged more? How many airport stores do you expect globally? I can answer that one. I think we certainly want to be in more airports. We are opening in Bristol Airport in about a week's time, and we think there are other opportunities. Obviously, Heathrow is always the golden child of the airport world, and so we'd love to get a site in there. So yeah, we're very much chasing that opportunity, and SSP have obviously got a great presence in all the airports and internationally. They've got a lot of sites in places like Frankfurt Airport, and so I think when you talk about the expectation globally, I think we would love to leverage our existing relationship with SSP to be able to explore things internationally in combination with doing it ourselves in those countries as well. So yeah, we definitely see an opportunity for more airport space. The food works very well in those environments. It's quick. If you're in a rush to get your flight, you can quickly eat it. It's not, there's not as much sort of sit down necessarily needed. Okay. So the next one was, how will Taco Bell's expansion impact your business?
Yeah, good question. Taco Bell for us is, they are going quite hard at it, but it's a slightly different market. They are the fast food in Mexican casual. They're cheap, their product is frozen, it's okay for what you get, and they definitely, they do trade near us in a few locations. So would they be a competitor? Yeah, I think they would be a competitor, but I do think that there's a noticeable difference. Well, obviously there is, because they're sort of, 25-30% cheaper than we are. The answer to the question is, how will they impact us? We don't really know. They've got probably 4 or 5 sites near us. We still trade very well when we do trade near them. There's plenty of room in this country to have 2 Mexican businesses. So we'll see. Time will tell. But they are probably the one growing as fast as we are, the only one that's growing as fast as well. All franchise sites as well, I think.
Okay, then another question from Jake around dark kitchens. Will this aid faster expansion? How many can we expect? How can this be sped up? Would love to see more stores in the counties surrounding London. Yeah, I think the dark kitchens model is very well suited to what we do. We do perform very well in the ones in London, and actually we've got one in Manchester as well, which we opened as a bit of test and learn, because we don't have a store in Manchester. And so it was interesting to see how we would perform opening up a delivery dark kitchen, so to speak, without a brand there, and it's gone well. So I think there is a lot more opportunity. There's a lot of funds being thrown at the sector at the moment, and we've met some interesting businesses, and we've got a partnership with Growth Kitchen. So we do see a lot of opportunity. I think the biggest barrier to opening into all parts of sort of Essex, Hertfordshire and Kent and places is not so much the availability of delivery kitchens, but the availability of delivery riders. Delivery obviously very strong in London, but outside of that, the market is a little bit underdeveloped. So I think certainly in the cities, there's opportunity, but I think in the sort of more rural market towns, it's going to be a little bit longer time coming.
We're hoping to open in Canterbury later this year as well, so that's, I think that's Kent, isn't it?
Yeah.
Yes.
Okay, so from David, then can you go into more detail on the availability of attractive real estate for new locations? Is there any chance that you can accelerate your openings in the short term It's always an interesting question.
Yes, well, when we tell you the story and everybody hears it, everyone does get very excited, quite rightly, and then they say, "Well, wow, why don't you go faster?" And the truth is, we think that 15 or 16 sites this year, having gone from 4 to 5 in previous years, is quite a big step up. You know, we have brought in some more people into our head office team. They are all kind of getting their feet under the table and understanding the business. If opportunity presents itself to open more going forward, we probably would take that. But I'm also conscious there have been quite a lot of casualties in this sector, especially restaurant businesses that have listed in the past and haven't done so well. You know, I've seen businesses like, Bayer and the burger business. You know, they were a hugely successful business, grew too quickly, all went horribly wrong. I think we'll always take what opportunities are there for us, but we want to try and do it responsibly and carefully and make sure that this business is here for a long time and not just try and flog it for the next 2 years. I think there's still quite exciting growth for us.
Okay, so the next question is from David again. What are you looking to acquire? Do you want an additional brand, or is it to acquire attractive sites and rebrand to toilet tier locations? I guess both of those opportunities are obviously interesting. I think the opportunity to roll out our own business this year will keep us very busy. But a lot of brands have had success with virtual brands out of their sites. So I think both are potential opportunities, and we'll look at stuff as and when it comes to market if it's of interest, and there's anything that might be of interest to Tortilla and our shareholders. So there's no sort of firm things, but it's just I guess an aspiration of ours at some stage that might become available. Okay. Next one about, have construction costs meaningfully increased? How do you feel about your guidance of CapEx costs per new site of 350 to 425?
No, fine. I think we've not seen too much. I think there's potential concerns about how long it's taking to get the products in, but because we sort of bought ahead, if you like, because we knew we were going to do 9 sites this year. We bought ahead on some of the key things like furniture and kitchen equipment. So far so good in terms of costs for openings. We've seen no sign of increase.
Okay, there's a question from Mark around our 45 sites. Will these sites be primarily focused on delivery kitchen expansion or to explore further international opportunities? When we talk about the 45 sites, that's very much a bricks and mortar rollout story. We wanted to open nine a year over the next 5 years. The delivery kitchen expansion would then be on top of that. So we'd probably open sort of 3, maybe 4 sites a year of delivery kitchens to supplement that bricks and mortar rollout. And then on top of that, we would supplement that further with franchising opportunities. The international piece would then be on top of that. And if we were to do that, we would obviously have to sort of resource ourselves accordingly. But that's not our primary focus at the moment. That's a more of an opportunity in sort of medium to long term.
Just in the interest of time, I don't know how many we've got left, but we could probably take maybe one more, I think. Or we could try and quickly answer these. So can you discuss economics of Compass deal? Anything you can disclose your profitability and how it compares to a typical Tortilla location?
We can't disclose the franchise fee, but we can say that it's within the normal realms of a traditional sort of franchise arrangement. But one thing that we do is we do sell them our central production food. And so we're able to sort of leverage our fixed costs there and spread those amongst more businesses by supplying those franchise businesses as well. So that does create a slightly increased profitability compared to a normal arrangement.
You mentioned coming off 35% ROCE target. Can you elaborate a little more on your thoughts there? Is this too difficult to achieve or too limiting? Good question. No, not too difficult to achieve. In fact, we're substantially over that the last few sites we've opened, with the benefits of the rent market being in our favour and actually getting some quite favourable deals from landlords. It's just that I think 35% is a bit of a legacy from private equity, and if we want to expand and we want to grow quite quickly, is 35% necessary? Could be less than that. We're a pretty cash-rich business. We're in pretty good shape. Maybe that could be 30%. I think we'll just have to take a view. At the moment, that number is hugely achievable, but it's not written in stone that we continue with that.
Okay. Should we do one more then before? There's one here from Evgeny. Oh no, there's.
Oh, that's just a thank you very much. Thank you very much.
Thank you very much.
Very kind. If abroad, which country do you personally prefer to enter first in the EU? I don't think we can probably say that yet, but we have looked at various ones, and I think we would probably. Well, there are certain ones. I mean, Ireland's a good one, Holland's a good one, Spain's a good one, Germany's a good one. Those are the ones that probably jump out as the most potentially achievable ones. France is one that you would assume is, but we've heard some horror stories about France, so we might not look at that as a priority. So I think
Richard. And
a couple off, but thanks very much.
Absolutely. If I may just jump back in there, obviously we will make all of the questions submitted today available to you immediately after the presentation has ended. And ladies and gentlemen, we'll publish all those responses on the Investment Company platform where it's appropriate to do so, and you'll be notified by email when these are ready for your review. But perhaps for redirecting investors to provide you with their feedback, which I know is particularly important, can I just ask you for a few closing comments to wrap up with? Thank you.
Look, thanks very much for your time. The only thing I would like to say is I think I'm hoping that you probably came into this presentation thinking about another hospitality sector, another hospitality business, thinking, oh God, there's too much going on in that world. But I'm hoping we managed to convince you that we don't sit very much in the rest of the hospitality world. We are slightly different. We're very nuanced. We're slightly differentiated. We have a fantastic product at a great price. And actually, as things get more and more difficult, we tend to perform better. So I hope that the markets won't lump us in with hospitality and leisure generally, and we'll look at Tortilla as a separate business, and hopefully the information that we passed on to you today will make you realise that actually this is a cracking business and a great investment. And hopefully that's what you'll think. And thanks for your time again.
Thank you very much, Paul.
Richard, Andy, thank you very much indeed for taking the time to update investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Tortilla Mexican Grill PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.
Okey-dokey. So I hope you enjoyed that. I don't know if you're aware, but at the time I was making notes myself during my lunch break. And what I got from it was that They said 15 to 16 stores a year, but they also said that the CFO commented to say 9 a year for bricks and mortar stores, 4 to 5 delivery stores. I guesstimated 2 to 5 franchises from what they were saying, and 2 to 5 international based on the Middle Eastern stores. So if we get an average for that, that's probably 17 to 25 stores. And remember that if there were growth in the international market, let's say there were 10 markets who wanted to open up and open stores in 10 different markets, maybe clustered by language, you could easily have 50, 100 stores internationally. Maybe not next year, but maybe in 2 or 3 years from now. Likewise, delivery or dark kitchens, cloud kitchens, that could grow. Universities, sports stadia, train stations, airports, other hubs, B2C franchises. I think there's a lot of growth potential, and I wouldn't be surprised if in 3, 4, 5 years they start actually growing at 30, 40, 50 stores a year, which could be quite interesting because they only have 68 stores at the moment. Based on the revenue numbers that I came up with during the call, on average, each store produces about £1 million worth of revenue, and there's a 35% return on 35% return on capital. So I'm saying that I'm kind of thinking that the revenue is probably 30, 35%. The net is about that roughly, maybe a bit less. But remember, I'm using a very conservative 17 to 25 stores for a 5-year forecast here, which I think is exceptionally conservative. So I've put it at like by 2027, they'll have 200 stores, about 200 stores. And, I really think that they'll have a lot more than that. They could easily have 300, maybe even 400, maybe even 500. But let's go with 200. 200 at around 30, 35% net. Remember, there are other types of stores that generate a lot more than £1 million. Like the Gatwick one has 2.5. And as they grow their brands, their revenue should go up as well. So anyway, 35%, so about 70 million EBITDA. So that's interesting. And if we look at that at 10x valuation, PE valuation, that'd be 700 million. At 20x PE ratio, that'd be 1.4 billion. And at 30x, it'd be 2.1 billion. Their current valuation is 65 million. So even at the lowest PE ratio of 10, which would be very unlikely if earnings do jump by that amount, it's a 10 bagger or company that would go up 10x. If it reached a 30x PE ratio, which has happened to me in the past, I invested in Domino's Pizza UK, which at some point had a PE ratio of 40. But anyway, at 30 PE ratio, price to earnings ratio, it would be an over 30 bagger. Now, I'm not saying it's going to happen. I'm not saying it's definitely, they're definitely going to make this, but I think it's somewhat probable. I'd say it's 50-50 shot. Let's see. I really like the stock personally. I've got a lot in this as a percentage of my investable funds, and I hope you enjoyed this video. If you do like these kinds of videos, then make sure to check out YouTube channel Investor Chat and my other YouTube channel, Progress is Everything. All right, guys, take care. Cheers.